Good day, everyone. So this is our interpretation results to the Marathon Company. So this is the financial statements of Marathon Company as of December 31, 2021. Where in the balance sheet, where in the balance sheet statement we get the cash and cash equivalents and total debt to compute the enterprise to compute the enterprise value. Next is the income statement. So here we get the EBIT and EBITDA. We get the EBIT and EBITDA, and also uh, uh, the outstanding shares. So here we see that the income statement is positive, or they have the net income, in which indicates that the cost of the company is less than the revenue. So at this year, the Marathon Company slowly back to its positive income because they manage those environmental factors like COVID-19, because in the last statement of their net income is net loss, which the pandemic uh, hits their company, and mostly of the oil company are the most affected company in the COVID-19. So next is the computation of enterprise value and equity value.
The first activity is computing the enterprise value and equity value. We compute the enterprise value by using the formula of EV equals share price multiplied to the number of shares and add total debt less cash. So Marathon Oil Corporation has a share price of 16.42. We multiply it by the number of shares. We have 12,939,000,000 and add the total debt of 6,308,000,000, and we less the cash and cash equivalents of 580,000,000. So the enterprise value of Marathon Oil Corporation is 18,666,960,000. So this 18,666,960,000 is the measurement of their company's total value. As we all know, enterprise value is mostly used by the investors and analysts to know the calculations of a company. So the 18,666,960,000, or the enterprise value of the Marathon Oil Corporation, is the measurement of their company's value. It also includes the market capitalization of their company and the short-term and long-term debt, as well as the cash and the balance sheet. Next is we have the equity value. We compute the equity value by multiplying the share outstanding to the market price. So 788 million multiply to 16.42, we have 12,938,960,000. If we compare this to its previous year, their equity value decreases. It indicates that their liabilities this year increases than their assets. As we can see in the figures, the enterprise value is higher than the equity value. It is very common that the enterprise value is always greater than the equity value, since the investors figure it in factors such as companies' expected future earnings from growth and expansion. So they always tend to include in the value of stock certain factors beyond the liquidation of the company value. So next is the second activity.
So valuation multiple. So here we compute the enterprise value uh, with the formula of EV over revenue, EV over EBIT, or EV and EV over EBITDA. Then the equity value is P over price over earnings ratio. So the EV over revenue measures how much it would cost to purchase the company's value in terms of its sales. So the equal of EV over revenue is 3.41. So if the company has a low result for EV over revenue, means they can provide immediate benefits to an investors. It is also one of a sign of investors to invest because they believe that the future sales of the company will increase. So in this situation, or the results is it is more than 3, which indicates a riskier purchase and require much more time to making profits, because EV over revenue generally range between 1 and 3, or anything below 1. So if anything below above 3 is regarded as quite high. However, it depends on industry and the company's competitors. So next is the EV over EBIT. The EV over EBIT of this company is equal to 14.27. So their EV over EBIT is higher. So means they have a low debt and higher amount of cash. It indicates that the company has a high debt to a cash, which mostly attracts investors. So next is the EV over EBIT is result to 5.53. So if the EV over EBITDA is lower than 10, seems the company seems to be healthy. Next is the equity value with a formula of price over earning ratio. The price over earning ratio results to 13.68, which indicates that the share cost is 13.68 times the profit that makes on a per share basis in a year. So that's all. Thank you.